Derek Steed has been an invaluable partner with his business advice and legal work, all pro bono. And several people at Wishart Norris are owners, investors, and supporters. I don't think a day goes by when I don't ask him, hey, can we do this? Can't we? What do you think about this? What about that? Derek will explain what preferred shares are and will answer questions you may have about these shares.
Thank you. Well, I'll talk a little bit about what are preferred shares. You all have received in the mail, every owner did, the proposal for a change to what we call the charter documents, or those sometimes referred to as articles of amendment, that would create a new segment of ownership for shares within the company. Now, some important things, though, are to differentiate what this is different about an ownership in the company when you purchase. Everybody, myself included, when you bought your ownership, you became one of the 1,610, if that's the last count, owners of company shops. And each person has one person, one vote, equality rights. What this proposal does with these articles of amendment is to create a new investment vehicle for company shops so that that $300,000 reality can get whittled down as quickly as possible while meeting the requirements of the USDA. One thing that's important is it does not change from that one person, one vote concept over in the owners. Preferred shares, as if you were so bored as to read through the articles of amendment, are a class of stock that would have no voting rights. Instead, they are a class of stock that recognize people's investments who put money in to buy those and would receive a return on the investment. These returns, in essence like an interest payment, would mirror what we currently have in the community investment notes. So if we were paying 1% on a $2,000 investment in a community investment note, we would offer also up a 1% in a Series A1 offering. What's required in order to accomplish this and to make available this separate class that allows us to get closer to that $300,000 goal, as well as to meet that USDA requirement, is for you, the owners, and those who are present by proxy, to vote in favor, or you certainly can vote against, but for those who vote in favor of modifying the articles of incorporation of company shops that currently list just one class of stocks, that will now include an additional class of stock broken down into these series, A0, A1, A2, A4, and A5. And if you wonder where those 1, 2, 4, 5 numbers come from, those are exactly mirroring what currently exists with the community investment notes for company shops. Now, a couple other elements that make it like those community investment notes. Currently, the community investment notes can be repaid at any time by company shops, and so too would a preferred share. The company shops board would have the ability to what we call those shares. In essence, repay the loan that's the payment that's been made to them. Also, after a 10-year period, anybody who owns a preferred share could then submit to the board and say, I would like to be bought out at this time for what I paid into it. Now, they would have some limits. If there isn't sufficient funds for company shops to do that, the board could restructure how that payment is done. But there is that flexibility. And that differs from the community investment notes because currently that ability to ask for repayment of a community investment note holder can occur after 5 years or after 10 years. It depends upon each individual's note. So this would extend it out to 10 years. And this would allow, under the generally accepted accounting principles, according to Scott Thomas, the CPA for the company shops market, to be able to be deemed equity so that we meet that USDA goal for the amount of equity we have in company shops market. And importantly, like the community investment notes, it would pay out a certain percentage each year. Now, there's a difference. With a community investment note, that is a debt. That is like your mortgage payment, which you owe that obligation of that interest payment out. So company shops every year owes that interest payment out to a community investment note holder who has a 1, 2, 4, 5 interest rate. Obviously with a 0%, they do not. But with a preferred share, that obligation would only exist if there are sufficient profits that year. So it does differ. So someone who is purchasing a preferred share does differ from those community investment notes because one is the form of a loan, but one is in form of an equity ownership that is reliant upon their main profits from year to year. But in order to make up for some of that, there is the additional ability of the board to offer us up to an additional 2 percentage points of a dividend if there are sufficient funds. And those dividends, like community investment note payments, would come before anything could come out to the owners. So the preferred shares would indeed be preferred over the rest of the owners financially in regard to the liquidation rights of the owners, as well as those dividend rights. But again, the dividends don't happen unless you have those profits. So the structure you see up here fairly mirrors those community investment notes. But something's important about that, and I think you'll notice that. We didn't make a mistake in leaving a zero off those A0 notes. One of the things that the board pushed for is to say, you know, we've had these community investment notes out there, and we've had this ability for people to come and buy, and we've had a $2,000 minimum. But we've had a lot of people say, you know, I really want to be a participant. I want to have a choice in what I do with my money to help company shops market. So they made the choice that in creating these preferred shares that they would lower that minimum for the A0 notes so that anybody with the $200 investment could be a preferred share owner. Now keeping in mind, these preferred shares would only be offered to existing owners, so anybody who does make that purchase would already have made the purchase, or at that time make the purchase of an ownership, so there would be one person, one vote over on the ownership side. So we have a nice opportunity to provide what I call another tool in the toolbox in the equity fundraising of company shops market. And we have a great incentive with USDA to be able to do that. And we can do it in a manner that does not affect the current owners in their voting rights and voting power of that one person, one vote that currently exists, but instead allows an opportunity from a financial standpoint to have a preferred share. In order to do that, later in this meeting, I believe the President will be calling for a vote on this issue. But right now, I'd like to take this opportunity, before we even get to that point, to be able to answer, to the extent I can, any questions anybody here has about this. With that, I'll turn it over to your President.
There's a question.
We do have a question, yes, thank you.
How much do we currently have in member notes?
I will point to you on page 2.
I'm trying to find it in here.
Yeah, if you look on the second page in here, and you will scroll down to the bottom half where it says liabilities and stockholders' equity. Mm-hmm. Under long-term liabilities, you see a note payable investors of $386,000. Now, I believe, Sharon, correct me, that $50,000 of that is a foundation, a note from a foundation. So really, I would put it at $336,000 is what you have in the current outstanding notes for community investment notes.
So if those are considered liability and people can change that to preferred shares, if everybody were to do that, does that mean we've raised our $300,000 and ready to go?
It does not, but what you asked is actually an excellent question. Two of those elements that Tom had raised were the important things for the USDA is that you have a sufficient amount of money in the system and that in hand, and that the money you have is counted as a percentage of it counts as equity. So currently, as you point out, those $336,000 do not count as equity. It's cash in hand, but it has an offset to it because it's a note, it's an obligation to pay that back. If all of them did that conversion, you would improve the position so that you may meet that equity percentage requirement, but still the cash on hand needs to increase by $300,000, so you still need $300,000. Any other questions? And I won't rush off stage this time.
Eric, I didn't hear clarity on the discretionary dividend. Would you just make that point again?
Certainly. Okay. Two types of dividends that preferred shares would be eligible for. One would be, to the extent that there are profits, would be up to the percentage you see listed there. So if you made a $2,000 investment at the 2% level, you are eligible up to a 2% dividend to the extent that there are profits. And it would be pro rata across all of those things. So if you didn't have enough to pay out the entire percentage for all of them, it would be pro rata among all of them. If there are additional funds, the board can elect at its discretion to also issue up to, and again, so it's flexible to the board, up to an additional 2%. Now, where that differs from the community investment notes is that 2% is fixed. It's not an up to, it's a fixed 2%. If I have invested with a community investment note $2,000, I am to be paid 2% of that each year. Bob, you think that sufficiently covers that?
Right. The point I wanted to make clear is that a Series A0 investor would receive a discretionary dividend if it were declared by the board.
Could receive up to 2%, that's correct. But the mandatory dividend where the first up to is